What's going on, guys? It's Will Caban, and today I want to talk about mortgage interest rates and how they've climbed faster this year. And I'm talking about the beginning of this year all the way up until now, faster than any other year that they've ever climbed before. Clients are just getting discouraged simply because of the fact that we have an affordability issue. What I want to do is I want to show you numbers on where the changes were, where the expectations are for interest rates, and then take you on what that journey might look like in the future. So what I want to do is show you a comparison of how this is really impacting American families with an example of $400,000 loan amount and where rates were at the beginning of the year. Average rate was about 3.125, which meant that the principal and interest payment only was roughly $1,740. Now, when you introduce where rates may end up by the end of the month, we very well may see 7%. And what that means is on a $400,000 loan amount at 7%, the monthly payment, principal and interest only, goes up to $26.61. Now, this represents a 55% increase in payment, which is a substantial payment increase. Now, when you look at the monthly payment difference, we're talking about a $950 monthly payment difference in almost $77,000 in a 5-year period that you'd be paying in additional principal and interest payments, and then the interest over the life of the loan is substantial when you compare it at 154,000 versus 375,000. But this is not the full picture. And the reason why this is not the full picture is because this is assuming that price points didn't appreciate. And we didn't have any sort of appreciation throughout the year, which we did. So if I took the real number and say did a loan amount comparison at 450 at 7%, you're looking at now a almost $3,000 monthly payment, just principal and interest, and that represents a 75% increase in payment versus the 3.125. Now again, this is just from January through September, 9 months where we've had this appreciation. So of course, it's a big problem and it's a big concern for a lot of families. So I do believe that we're at a point now where something's got to give. Either interest rates need to come back down or sellers' price points need to adjust and also come back down. And I think it might be a combination of both. But we know, reading into the chairman's speech, that they have no interest in reducing interest rates right now, which means that rates will most likely be elevated for some time until we get to a point where we start to see some recessionary drawback. And a byproduct of that is going to be the fact that sellers need to start reducing sales prices to a point where buyers feel comfortable purchasing given where the interest rates are. Now, historically, anytime that we get into a recession, interest rates tend to decrease. But typically the reason why you see that is purely because of the fact that interest rates go down, appetite for risk becomes greater for buyers that were more or less on the fence when rates were high. And that in and of itself creates some opportunity. But what if you didn't have to, as a seller, reduce your sales price? What if there was some other benefit that you can offer a buyer and be able to still try to capitalize on where the appraised value is still coming in because they still are supporting the higher price points? Something like a 2-1 buy down, where the incentive for the buyer is for the first year their interest rate is reduced to 2%, the second year their interest rate is reduced by 1%, and that third year their interest rate goes back to what the going rate is on the loan. And I'll run through a scenario of what that looks like using the same numbers and same examples right here. All right, so what you're looking at over here is two scenarios that are looking at the same interest rate. The major difference is that we are looking at a interest rate at 7% with the amortization based off of the 7% starting from month 1. And here we're looking at the rate buy down increasing the first year from 5% to 6%. Second year from 6% to 7%. The first year's payments are going to be $578 less expensive. And the savings over a 5-year period, assuming that you keep the loan for that long, would be about $14,000 in total payment. And the interest paid over a 15-year period versus a 2-1 buy down would be roughly $16,000. Now again, this is under the assumption that you're going to keep this loan. But ultimately, if we go down here and we look at payment stream, okay, the payment stream is basically giving us an idea of what the first year's payment looks like. So it's $24,570. Then month 13 to 24, you're looking at a $26.91 monthly payment at an interest rate of 6%. and then the following payments would be 29.73.35. The idea again behind this is that it creates an opportunity to put a person in a property at a lower monthly payment. We would still be qualifying the client based off of what the actual interest rate is. So in the example that I just showed, assuming 7%, and we're being very, very aggressive in that number, but assuming 7%, that's the number that we would qualify the buyer off of. So to be very clear, this is not one of these loan strategies from 2008 that would put a buyer in a worse situation. If you can't qualify at the higher interest rate, you can't qualify for this type of mortgage. So what you're looking at is the Epic Mortgage Team's internal temporary buy-down worksheet. It breaks down what the actual total buy-down amount would be paid by the seller or the buyer or a portion of both. Now in this situation, it's very simple math. All it is the total savings added for the first year and the second year, and that is inevitably becomes what the cost is. So it's very basic in the sense of what the actual numbers are, but you obviously want to have the calculations correct. So if you do 579 times 12 and you take that total number and you take 296 times 12 and you take that total number and you add the sum of the first year total and the second year total, this number right here, the 10,500, is the number that you get to. And I already did the math on it, but on a purchase price, let's say of 450, you're essentially giving the client, as a seller, or the cost would be 2.3% of whatever the purchase price is. And in a situation like this, that's very doable in a market where if you're going to reduce the sales price, especially if you're going to reduce the sales price, by more than 2%, then it is very worthwhile to entertain a strategy like this. One of the main reasons is because you have the ability as a buyer and a seller to split these costs however in which way makes sense. We just need to be conscious of the max interested party contribution. The idea here is it gives you a different strategy in presenting some type of benefit to buyers. And it's not just the, hey, let's reduce our sales price immediately because market doesn't support it. The market very well could be supporting it. And I'll be very honest with you, appraisals right now are not coming in low at the clip that they were last year, which is very surprising. So the market is supporting certain price points even after certain reductions, because we have seen certain reductions happen. But the truth is, if your seller is at a point where they are either, opting to reduce the sales price to entice and be competitive, or they want to entertain a different strategy, this is definitely something that we can entertain. We could go through the dynamics of how you would actually have to word it so that it's in the actual description for the property, so people can see this, buyers can see this, buyers agents can see this, and myself and my team, we'd be more than happy to run any questions and any answers that you have based on the product. It's a very easy product, a very easy program. It's nothing bait and switchy. All it is looking at the market, looking at where rates are right now, and thinking outside the box a little bit. Now, the benefit to buyers in this situation is that if the inevitable happens, which we do believe there's going to be a recessionary period, which is going to offer us the opportunity to be able to reduce interest rates by way of doing a refinance, there's two questions that come up, right? If this does happen, what happens to the money that is on the sidelines that is, for the benefit of the buy down? And the truth is that $10,500 in the example that I had presented over here, it's going to be in an escrow account. And that money is essentially going to be used for the benefit of reducing your monthly payments. And if you were to say refinance within, say, the second year, and you still have money in the escrow, which you would, inevitably what would end up happening is you would have that, whatever the excess is in that account, pay down the principal balance. So you never lose any money. If that money is always yours, and it's always for the benefit of reducing the principal amount, you're not going to get it back, right, as dollars to you, because it's always there for the benefit of making that difference up in the first year and second year payment. We're looking at the Fed's projection that in 2025 we are going to get interest rates, or at least economically we're going to get to a point where there's going to be some balance, this can fall squarely right in there, right? First year, it's your interest rate would, assuming that it's September 2022, your interest rate would increase the end of 2023. Second increase would happen the end of 2024. And then what would inevitably happen is you would run the interest rate at the base rate, which is 7% in this scenario. And if there is an opportunity within that time frame to do a refinance, you can take advantage of that. You can capitalize on that and be in a position to not lose any of those funds that you have on the sideline. So this is just one strategy. I know, again, this is a really lengthy, wordy video, but I wanted to show you this because right now in a market like this, where there's a lot of projections for doom and gloom, is it the right time to buy? Is it the right time to sell? This is just one way to offer some sort of benefit to sellers and to buyers. If you have any questions about anything, feel free to reach out to me or my team, and we'll be more than happy to speak to you guys about that. Thanks and take care.